My name is Nate. Welcome to the DivMan channel. Today I want to talk about some potential news about Roundhill ETF's RDTE funds and whether they made it the whole year through paying return of capital dividends. Now, you may be wondering what precisely are return of capital dividends? What is it? What difference does it make? Well, typically, my understanding is there's basically three kinds of dividends. There's qualified dividends, there's ordinary dividends, and then there's return of capital. And just to simplify things, return of capital is basically the dividend issuer, the ETF issuer handing you back your cash, either because the fund itself had losses or they just decided to pay a dividend that keeps with investor expectations. Roundhill ETFs actually did a big article about why do they do return of capital as a dividend strategy. They actually aim in their weekly payers to use return of capital as the dividend method. And so this is their article. They go over it. I can link this in the description and maybe a comment below. But basically, this just goes to show this is kind of the major thesis behind Roundhill's dividends, and you can look at that article to see. But what I wanted to show here is the fact that some of these weekly payer funds, whether it's QDTE, RDTE, or XDTE, following NASDAQ, the S&P 500, and Russell 2000 respectively, whether these actually made it through the year paying return of capital. I do want to say that this is preliminary information until you get your end of year 1099 div form from your broker. You're not really going to know what kind of dividends they are. And let's just get to the chase of why it's important. Basically, the return of capital stuff means that so long as you don't sell your shares of whatever the fund is that's paying these dividends, you don't have to pay taxes on those return of capital dividends until each share pays for itself in dividends. So that could take a little bit of time before you even have to pay one dime of taxes on these Roundhill ETFs. And so if they're paying any sort of dividends that are not return of capital, it's going to mean a larger tax bill if you're using a brokerage account or a taxable account. Now, if you have it in an IRA or a Roth IRA, it's not really a big deal. But just to show you what I mean, here are the 19A forms, and they are only doing these calculations based on their monthly accounting. And this is required for them to do it monthly, so we don't yet know exactly what's going on with these funds. So just to be fair, this is not a definitive word, but this is sort of like an interesting insight here. So here are the year's 19A forms. This is for QDTE, the one that follows NASDAQ 100. And as you can see, back in March, they're expecting the return of capital portion of the dividends that were paid to be 100% for that month. Now, not definitive yet. It's not until end of year that they really make the final accounting decision about whether these dividends were indeed return of capital. Here's one from June, and 100% return of capital, 100% return of capital. Preliminary, of course, just reminding you, and then here we get to end of year. And remember, they paid a bit of a larger dividend end of year. And as you can see, the dividend for December 20th of 2024, it looks like that particular dividend is not expected to be return of capital. So if you are expecting these Roundhill ETFs to pay nothing but return of capital, just keep in mind, to put a little bit of your Roundhill RDTE fund dividends as, possible tax money come tax season. If you're using a brokerage account that's taxable. Otherwise, use a tax advantage account like a IRA or Roth IRA. Yeah, that's basically the short and sweet point of this video. Is we may end up with a teeny tiny bit of the dividends that QDTE paid out this year as taxable dividends. Just wanted to highlight that because I haven't heard anyone talking about it. But considering that it looks like they got most of the year based on their expectations in these 19A forms, it will probably mostly be tax advantage dividends unless you sold your shares, which, by the way, how the return of capital taxation stuff works, basically when they hand you your money back with the return of capital dividends, it basically means the cost you paid to buy the share is lowered. And so if you hold it long enough, what ends up happening is when you sell, you're selling at a much higher capital gains rate, because your cost per share goes down each time they pay you that return of capital dividend. So that's a great encouragement for those of you using these funds to just hold on to the funds. Don't day trade them. Don't flip them. Don't sell when the market goes down. Just let them keep paying down, because you really are in a great situation tax-wise, potentially, just by holding the fund. That's really the point of this video. I will link that article, and I will also link the IRS website that discusses return of capital and how it's treated by the IRS. Anyway, like and subscribe. Share this video if it was helpful. Leave a comment if you have a question, a concern, or if you just like the video and you want to leave a comment. Thanks so much for your time. Have a good day. Bye.